As you know, we always have an idea for a theme to characterise where we think the economy is and is going. And this one has got a more optimistic theme this year, which is turning the corner. And it reflects the idea that we can see across a range of indicators that things are starting to take a bit of a turn upwards in terms of the economy. It may be a pretty tentative step upwards at this stage, but when we look forward to what we should reasonably expect through the balance of this year and into next, we've got good reasons to expect that 2025 and 2026 are going to be a lot better than the rough year that was 2024. So we've got this kind of nice relaxing picture of a nice road sort of gently turning off around the corner. You can't quite see what is around the corner, which is always the case. But I'll also direct you to the mountain, actually the volcano sitting there in the background. It's Mount Taranaki. And that really characterises that there are a few troubles out there on the horizon and things that could potentially erupt and upset the apple cart. And that's Mr. Trump, the new US administration, and some of the stuff that's going on with the global trade environment right now. So I'm going to talk you through basically something about all of those things as we go through. So before I actually tell you anything though, I'm going to get you to tell me something. We had a pretty rough period trying to predict GDP in the last 6 months. I'm not sure where's Michael, he's our GDP guy. He's tried to create a nowcast model and that got blown out of the water by Stats NZ's data in the last 6 months. So you tell me, what do you reckon GDP is going to do in the next 6 months? You know, is it option A, it's pretty negative, this recession ain't over and GDP is going to remain negative in growth terms? GDP rises a bit. It remains a bit below par, really. GDP will reach trend levels perhaps by the middle of the year, or it's boom time, baby. We've got a growth explosion about to occur, and there could be some reasons for why you might think that, depending on which things matter most for your business. Let us know. So we're at 92, we'll see if it stabilises up there. A few more coming in. GDP rises a bit, but remains below par. And actually quite a few pessimists there as well, which is interesting. Alrighty, we've got about 100 votes, that's a good sample. GDP rises a bit, but remains a bit below par. And you know, that's not actually far off what we're really expecting. I don't think we're really in the situation now where it's boom time just yet. But as I'll show you on the next slide, if we have a look at some of the kind of higher frequency indicators of where this economy's been travelling in the last year, it's a pretty messy picture. As you can see, there's quite a lot of indicators doing different things at different levels. That's the life of trying to be a macroeconomist in New Zealand. But what I'll point you to is that in the middle of the year, around about July or so, pretty much all of them took dips through that sort of March through July period, to the greater or lesser degrees. And that does correspond to the period where Stats NZ has reported that we had two quite large drops in GDP. I think we got a -1.1 and a -1 for Q2 and Q3 respectively. Those growth rates probably do overstate just how weak things were. I don't think we had the worst recession in New Zealand since 1991 in the middle of last year, but we certainly had one. But the good news is that if you look at most of those indicators since the middle of the year, and particularly after the Reserve Bank started cutting rates, they've improved to varying degrees. Things like business confidence being particularly strong. That's that black line at the top of the graph there. Basically, businesses have been, despite seeing weak conditions in the here and now, have been pretty optimistic about what's going to happen next. But we have seen a pickup in consumer confidence as well. It's a bit more tentative. The manufacturing, sort of like services sector PMIs have actually started to pick up, and now they're sitting a bit above trend now. The indicators that are most weak right now, continue to be in the labour market, which is that kind of orange line at the bottom where you see job ads are still lurking, a couple of standard deviations below trend. But you probably should understand that that's likely because the labour market lags the real economy, typically by 6 months. But nevertheless, that weak labour market is a lot of the reason why consumers remain still a bit tentative right now. Businesses remain a bit tentative. And it's probably going to be 3 to 6 months before we get a convincing pickup across the economy. In terms of our growth forecasts, you can see here the purple bars obviously been very negative through the back half of last year. But actually expected to pick up. We think we're probably going to have a small positive growth rate in Q4 when that data is released next month. We think we've got a plus 0.3, I think it is, for that quarter. We think that's still actually a pretty flat economy in underlying terms. There's actually a bit of statistical volatility being introduced with some of the more recent GDP revisions that might mean that growth was probably understated in the middle of the year and will look a bit stronger through the back end of last year and early this year. But in general, we see basically that once we get to the middle of this year, we should probably be operating at pretty close to trend growth, which would be about 2.5% growth for 2025 and about 3% growth, so slightly above trend for 2026. The average over the whole forecast period is 2.8. So it's like better growth. It's kind of essentially a picture of a return to trend growth as opposed to a boom. It's certainly not as strong as the pre-COVID average level, but it is a recovery. So then the questions come down to sort of like why. One thing that we sort of have here with the recovery in the economy is that we do expect that the labour market will eventually stabilise and start to recover as well. As I mentioned, the labour market typically lags the real economy perhaps by six months or so. That means the unemployment rate is going to continue to rise to around about 5.4%. We've actually revised down our estimates of that in the last few months in terms of the peak. So it's still got a little bit of increase to go from here, then it'll start dropping back as that economy hits trend growth and starts to rise. Wage growth will continue to decelerate for most of this year, reflecting the fact that the unemployment rate will be operating above its long-term average, above its NAIRU level. Basically, people would not be expected to be getting large wage rises in the next year or so. Saving grace, of course, is that inflation is a bit lower. So what they are getting, they get to keep. So that brings me to my next question. I always get asked this question, so I thought I might ask you guys first. When's going to be the best time to fix my mortgage for 2 to 3 years? Second half of the year. Very nice 4.99% mortgage rate available from Westpac right now, 3 years. Next few months, not now, and obviously happening sometime this year. What have we got? We're up to about 100 odd votes, so that's right. So second half of the year. So I guess that's kind of consistent with the idea that mortgage rates in general settle in the second half of the year, which is actually not far away from what we're forecasting. So the first big driver of this recovery and growth that we see this year and into next is really reflecting the quite considerable fall in interest rates that's occurred since August last year. Now, after this week, when we get a further 50-point cut, there will have been 175 points of cuts delivered quite quickly. After that, we're expecting another couple more interest rate cuts to take us down into the low threes. And what that has done is significantly reduced mortgage rates. The kicker on this as well is that as those mortgage rates have declined, what we have also seen is that Kiwi households are in a great position to take advantage of those lower rates as well. The chart area on the left-hand side of this chart just tells you how many mortgages come up for repricing in different horizons, and over half of them are going to reprice in the next 6 months. So everyone's going to get an opportunity to get a lower interest rate in the next few months or so. And you can see here there'll be a combination of, firstly, the mortgage rates probably like to settle in the sort of like low fives, I think. But also people are going to increasingly migrate away from those relatively higher floating and short-term fixed rates to probably something a bit longer where those rates are a bit lower. For example, Westpac's market-leading 4.99% 3-year rate. To give you an idea about what that's worth, this just simulates for the average borrower, you know, how much release they're getting in their back pocket. And I like to look at the 1 year part of this chart because I think that's a reasonable benchmark for sort of where Kiwis have been in the last year or so. And, you know, a year ago, basically, you would have been borrowing at 7.3%. And now it's about 5.5%. You could probably get a sharper deal than that, depending on how hard you ask. That's 175 points off the rate. That's delivering, say, $300 to $400 a month extra into the pocket each month. So, you know, that's multiples of what the tax cuts delivered last year. It's quite a decent sized fill up to budgets. And in the end is the thing that I think will really support consumer spending, business activity as we go through the year. Obviously for businesses as well, they've had the full impact of a lot of these interest rate cuts for a while now because businesses tend to borrow a bit shorter. So my next question then, because what always naturally follows from a discussion of mortgage rates and interest rates is what are house prices going to do? You think house prices will be flat in 2025 or maybe down? Perhaps just rise 5%? Up by 5 to 10%, or are we going to have a bit of a stronger bounce in house prices this year? House prices basically went backwards by a small amount in 2024. Up less than 5%, up 5 to 10% look like the most popular options. Flat to down, that seems like a minority view. I've got a couple of people on my team who would vote for flat to down. But I think most people agree that when you give Kiwis a bit of a rate cut, then there probably will be some impact on house prices because Kiwis love a good rate cut. So if I flick forward to my forecasts for the housing market, what you can see there is this is a reasonable relationship I think you'll find between sort of where mortgage rates have tended to trend over history and what house prices do. So it's like the change in the average of the 2 and 5 year rate as a proxy for the general level of mortgage rates, inverted, and then against house prices. So obviously falling mortgage rates equate to rising house prices. You can sort of see there this works quite well. And in terms of our forecast, we've got a 7%, I think it's about a 7.2% rise in house prices expected for this year, a 5% rise for next year. And, you know, if anything, that would probably be a bit on the low side for sort of the size and the mortgage rate fall that we're actually projecting that we'll see as we go through this year. The thing I'll say, though, it's a pretty rough relationship. But basically, we're expecting a recovery in the housing market. It's not a particularly strong one. I don't think we've got reasons to expect a bit of a boom. You know, we've still basically got an economy that's only operating at trend. Population growth should start to recover, but it won't remain at particularly high levels. So we've got this idea here that we've just got a modest recovery in house prices. That's probably a bit more optimistic, I think, than the survey result we've got here. So we'll just have to see how that pans out. So my next question, where's the unemployment rate going to peak? When I told you what our view was, basically in the low fives, but how do you feel about this thing from the perspective of yourselves or your businesses? Will it peak higher than this, 5.5 to 5.7% perhaps, or even quite a bit higher? Got over 6% in the GFC, for example. All right, so there's a sizable minority there that think that the unemployment rate might just kick on a bit further than that 5.4% that we have. And I will note the Reserve Bank as well don't expect that the unemployment rate's going to go up very much further. It's sitting at 5.1 now. They think it's going to peak at 5.3, I think, if I remember correctly. I don't think these levels are very much different, although one thing I will say is that I suspect the performance of the labour market will be quite important in determining what the Reserve Bank ultimately does with interest rates this year. Because if this unemployment rate does overshoot, I think they'll be quite keen in taking action to offset that. Because in general, I think they'll have this view that inflation is fairly well controlled now, so there's not really any particular reason to want to have the labour market any weaker than it's currently been projected. So interest rates, that was the sort of first key driver of the pickup in growth that we're projecting this year. There's another key one as well though, and that's commodity prices. And I've just selected our farmgate milk price here as an example. It's actually probably one of the stronger categories, but one of the good things that's happened in New Zealand in the last 6 months or so is that we've had a reasonably broad-based improvement in commodity prices. Our terms of trade, which is basically the ratio of the prices that we receive from our exports relative to what we pay on our imports, improved 17% last year, which is a very good year, like right out there on the sort of positive end of the distribution. Milk prices have risen quite considerably in the futures market. The exchange rate has depreciated. And what all of that has meant is that we're now forecasting that in the dairy sector, we'll get a $10.30 payout for this season, which is slightly above the $10 that Fonterra's currently projecting, but inside the range that they're expecting. And even for next year, our starting bid for next year is $10. And that does assume that the exchange rate remains relatively low, but also it does assume that dairy prices do fall a bit, because we think they have been a bit overbid in recent months because the Chinese have been building inventories. But what that tells you is that that's a couple of years of very high nominal prices, even in inflation adjusted terms and cost adjusted terms, which is what that red line there is. You can see that it's not a record income level, but it's pretty good. And that is going to have, I think, a reasonably significant impact on business activity and spending out in the regions, especially as we go through this year. You know, us townies in Auckland, I mean, we only ever really care about latte prices and our house price, right? But out there in the real economy, these people actually earn export income and they're getting it. Favourite story I've got right now at the moment is 3 weeks ago, my nephew called me up. He's a share milker down in Canterbury. And he said, "Oh, Kelly, I've just gone out and bought a Ford Ranger." It's because he's having a very good year. I dread to think what will happen when his wife finds out how much he's getting. But that is how it rolls out there, right? This is a good year for the farmers. We should expect basically a bit of support coming through the economy out there from the regional economies. And I am highlighting milk here, but you can see it in the meat prices, which have actually started to recover now. They're not at record highs by any stretch of the imagination, but it's looking better than it did perhaps 6 months ago. Log prices have improved. And, you know, even actually the horticultural sector is doing particularly well. So out in the Bay of Plenty and Tauranga, those farmers will be very, very happy this year, because to a large extent, a lot of these farmers have been hit with the perfect storm here, where, you know, a perfect positive storm where they've got good prices, they've got low exchange rate, they've actually got some product to sell this year because we didn't have any bad weather events. Milk production, for example, is really, really high this year. Same with horticultural production. And of course, costs are declining as well, because interest rates, as well as a whole range of other costs, are not inflating at anywhere near the sort of levels they have been in recent years. So that's all pretty positive. In terms of a scaler actually on that, basically even just the dairy increase, we reckon probably adds 1 to 2% of GDP or something like that, basically in terms of incomes. But now we have to get to that big volcano we talked about at the start, the trouble on the horizon. As you probably have seen in the news, there's a lot more talk now of more protectionist policies being advanced in the United States, with the potential for retaliation around the world. The Americans have announced steel and aluminium tariffs, which are actually global, so they impact on some of our businesses as well. And I guess it really does raise the question about to what extent will this new, more difficult trading environment upset some of the more positive factors I've been talking about the outlook earlier. So what do you think? What do you reckon the main consequences of tariffs will be on New Zealand and on New Zealand businesses? Is it going to be not really that much impact because it's all just a bit of a bluff and in the end deals will be done and there won't be that many tariffs? Will there be enough to slow the economy and push up the unemployment rate? Is inflation going to rise? Because a tariff is actually an increase in the price of imported goods in the country where the tariff is exposed, but then you also tend to see exchange rates change as well, which exports some of that inflation around the world. Do you think that inflation might fall because perhaps there's a whole lot of goods that would have been exported to the United States which will end up here? I heard the Reserve Bank Governor cherry pick this one out at the November MPS to say, well, look, maybe we'll get some cheaper EVs out of China or something like that, which will push the CPI down. Or is the exchange rate really going to be the big factor that will come out of this? Will we see a continuation of what has been a pretty weak exchange rate in the last 6 months or so? Let me know. Yeah, so what have we got? We've got over 100 votes. Exchange rate is going to fall, seems to be quite prominent. I reckon that's very astute. I think that is, in fact, that is how it works with tariffs. If you look at the international experience with tariffs over a long period of time, typically what happens is the country that's imposing the tariff has their exchange rate appreciate a bit, and everybody else's depreciates a bit, basically about 1/2 to 1. So what that means is that there'll be inflation in the country where the tariff is imposed, but also some of it will get exported around the world as well. I think that's pretty intuitive. So hence people that have picked E and C, I think that makes a lot of sense. A is quite interesting, nothing really because it's really all just a bit of a bluff. I have to say that that's actually the prevailing view in the financial markets right now. We put out a results of a survey we ran for our global customers last week, and that was actually probably one of the big views that came out of there, was the idea that Trump is just looking to basically do deals, get concessions from other countries by threatening tariffs, but will ultimately roll them back. I'm more pessimistic than that, to be honest with you. And I see down the bottom there, we've got lesser domestic impacts on this than perhaps you do on the prices, which I think is probably a reasonable characterisation of what's likely to happen. If I go into our outlook for the world, one thing I'll say is that we actually haven't revised down our global outlook really significantly at all this time around compared to before Christmas when we last did one of these things. And if we think about the impact of tariffs on global growth, we've tended to take a wait and see and frankly probably relatively sanguine view about how this is all going to pan out. In fact, if you look at your outlook for the United States, the actual forecast for the US growth is actually a bit stronger than they have been a couple of months ago. And I think that's really reflecting a view that we really don't know exactly how large these impacts are going to be, how broad-based they're going to be. We certainly don't know if they're going to significantly impact New Zealand. So there's not that much sitting there in the forecast for global growth associated with the more difficult trade environment. Having said that, I don't think you should necessarily believe that. I think probably it will be a downside impact on global growth. I think the tariffs will be reasonably broad-based and last for a while. But until we get a better sense of exactly what that scalar is going to be, we haven't really put that into the baseline right now. So it's more in the category of a downside risk in terms of global growth and New Zealand growth to some extent as well. In terms of the impact on interest rates, so we have a view in our forecast that interest rates globally are likely to continue to fall outside of the United States. In the US, the view the market has taken increasingly is that the Federal Reserve is less likely to deliver some significant interest rate cuts this year compared to what views were a few months ago. They did do 100 basis point cuts right before the election. But since then, the signs that inflation is receding in the United States have actually calmed down a bit, and it looks quite stickily high. And there's also the potential for a decent amount of fiscal spending in the United States as well. There's a big tax cut package that needs to be rolled over by the end of the year. It's one of the central parts of Trump's platform. Most of these things are likely to mean that US fiscal policy will remain fairly expensive as we go through this year, even though we've got Elon Musk running around there trying to cut spending here and there. I think he's managed to cancel a few website subscriptions so far. In Australia, we're anticipating 100 basis points cuts beginning with today. So this is going to be an early test, I think, of those forecasts. My Australian colleagues feel like the RBA should be sufficiently confident that inflation is going to track back to their 2.5% target in short order to mean that they can start reducing rates a bit. We think that the UK and the ECB will continue to cut rates as well, in the ECB's case down to about 1.75%. But the thing about all of these forecasts is you'll see is that if you compare the levels of interest rates where they end up by the end of the year, is that they remain noticeably higher than they were certainly during the COVID period and pre-COVID as well. I mean, the ECB is quite a good example. I mean, it's the lowest interest rate forecast we've got on the view. It goes down to 1.75% for their policy rate, but their policy rate was negative through most of the 2010s. And that's just telling you that we are in a world now where interest rates generally will be higher than they were in the decade or so before COVID. And, you know, if you translate that through to the New Zealand discussion, you know, like I've heard a lot of people talking about, oh, maybe I'll get a 3 or a 4% mortgage rate. Aside from Westpac's market-leading 4.99% 3-year rate, it's probably unlikely unless something quite bad happens. In terms of New Zealand's exposure, particularly to US tariffs, they're perhaps a bit larger than you might imagine. One thing you probably have to keep in mind is that New Zealand is on the naughty list with respect to tariffs because we have a trade surplus with the United States. They have a trade deficit. So Trump in particular is very focused on countries who are not paying their way, basically, people where they're not exporting as much as they're importing. The saving grace for New Zealand is that you have to go a long way down the list of countries before you even notice us. The real big focus is bigger countries like Canada, Mexico, China and Europe. That's where all of the threats have been dished out at the moment. But we do have some pretty decent exposures here for us. So if you look at that meat sector, for example, the dairy sector, even in the horticultural sector, the wine industry in particular, these are industries that could be quite significantly hurt by, significant tariffs. So it's certainly quite important to have in your mind as you think about, well, what are the scenarios that can impact your business over the next year or so. I got a couple of examples of some of the more prominent ones. Beef, for example, right? I mean, a lot of New Zealand beef goes up to North America and it actually goes into food services processors for burgers and things like that. But we compete with a lot of other countries who are also exporting into that market. So you can see Canada, Mexico, Brazil, Australia, as well as us sending significant exports of beef into that market. If there were tariffs on beef, they would apply to everybody. So all those other countries are going to be looking for somewhere to send their beef. And probably they would try to send that beef to some of the other countries that we already export to. So there are some kind of real risks there, I think, for our export prices. If, for example, the Canadians or the Brazilians decided to send a bit more beef into the Chinese market, for example, which is another big beef export market. Or in the case of lamb, because I haven't got lamb on this chart, but like the Australians could easily start to try to direct more lamb into the UK market as well. Sauvignon Blanc wine is another interesting one. I was actually pretty shocked to hear when I asked my team, what is our position in the US wine market? We're the third biggest exporter of wine to the United States. Can you believe that? Third biggest. We're not that big. We're miles behind, like Italy and France, as you should expect. But there's plenty of other bigger countries out there with a lot of wine. So and the other thing is that wine is actually a really important part of where we export all of our stuff to as well. So it's a really big exposure for that industry. You might have seen representatives from the wine industry on the TV a few days ago talking about exactly this issue. And if it does turn out that we're having trouble getting that wine up into that American market, then where else are we going to send it? We're going to send it to France. We'll probably try and send it to the UK like everybody else does. But yeah, that's a particularly big exposure, I think, for that particular industry. And those are just a couple of prominent examples. A few others as well. You heard about some manufacturers here that have got exposure to the Mexican tariffs, for example, the Chinese ones. I think Scalar and Fisher and Paykel examples. So there'll be a few stories like that as well. The steel tariffs, for example, the aluminium tariffs, they're both relevant to us as well, but they're smaller export categories. But they are illustrative of the fact that this is something that will impact us if it becomes reasonably prevalent and permanent. So which brings me to my question about the exchange rate, because I told you that usually the exchange rate is the buffer factor when some of these more adverse scenarios occur. So where do you think the Kiwi will end this year, bearing in mind that it's sort of sitting, I think it's around 57 cents or something like that today. So, C is the answer you put if you've got no idea. It's usually what I put. But what do you think? Is it going to be higher or lower? Yeah, a bit of a bias towards depreciation there, as you might expect. And I did notice this as well in the professional customer survey that we ran last week, as there was a bit of a bias there as well. I think there is a recognition out there that this environment of higher US tariffs is likely to mean that the US dollar remains relatively stronger for longer than you would expect, and that countries that are basically trying to export in there are going to see some depreciation. Our forecast is that the Kiwi will end this year about 54 cents, so that's a bit lower than current levels. And I will say that if some of the more negative scenarios come to pass, then I don't think it's out of court at all to think that you could get down to 50 cents or lower, really. The exchange rate is undervalued now. It probably will become more undervalued in those scenarios. That ultimately will probably be a good thing for New Zealand, because it will actually encourage ultimately the export sector, help repair the current account. But it's not that much fun for us townies who like to go shopping quite regularly, and much of the stuff we buy comes from overseas. So you will expect a bit of inflation out of that. So that's our forecast for KiwiUS, down to 54 cents. And then after a year or so, we do expect depreciation, because we don't expect the US dollar to remain at what are historically strong levels right now forever. That it will ultimately start to go back to sort of where medium-term fundamentals might suggest it. But I think this is a year where the medium-term fundamentals will take a back seat relative to some of the more shorter-term factors that are going on in the economies in the next year. We do think that the Kiwi will also depreciate a bit more broadly. On the basket, the TWI is expected to depreciate. We think Kiwi Aussie will go down to about 87 cents as we go through the year. We did pull up our short-term Kiwi Aussie forecast to 90 cents in this set of forecasts, because my colleagues in Australia pulled forward when they thought rate cuts would happen in Australia. So that kind of like tilted the bias for Kiwi Aussie in the short term. But I think that as we go through the year, if we see these sort of trends continue, you should probably expect further New Zealand dollar depreciation on a reasonably broad-based basis. So then the question is, well, what happens to inflation? You'll see there that our aggregate inflation forecast is sticking around 2%, but it is actually going to rise in the next 6 months or so. We've got a peak in the inflation rate of 2.7% in the middle of the year. And that's been crucially driven by what's happening to the blue line on the bottom of this chart, which is the contribution to total of inflation coming from tradable inflation, basically imported stuff. And that's all starting to rise partially because of the weaker exchange rate we've already seen and that we expect to continue. And also there has been some rising food prices as well, because the consequence is that if the farmer in the Waikato is getting $10.30 for his payout, that means you're paying more for your cheese. So that's one way of thinking about it. The same with the meat as well. So we're seeing a bit of a reversion of tradable inflation back towards long-term trend for a while. That's going to hold headline inflation up in the top half of the Reserve Bank's 1 to 3% band. And at the same time, the sort of domestic inflation component of the CPI, the thing that's probably really worried the Reserve Bank a lot in the last couple of years, should continue to fall because the economy is still operating below trend for a while. The unemployment rate is still operating above its NAIRU, so there's downward pressure on wages. We should expect that business costs will continue to decline, and as a result, that non-tradables number should go back to something a bit closer to the sort of low 3% level, which is consistent with inflation remaining around 2%. I guess the one thing I'd highlight to you here, there's nothing in this forecast telling you should expect 1% inflation in the next year or so. And, you know, if you had a view that you thought you were going to get large interest rate cuts this year, you would probably need to motivate that with the idea that inflation was heading towards 1.5% or 1%. And there's nothing in this forecast in support of that idea right now. Domestic inflation, as I noted, is expected to continue to moderate. It continues to be held up, though, by a few special categories. Insurance and rates, for example, have been rising really strongly in the last couple of years, and we're expecting both of those categories to decelerate somewhat, but still remain relatively high. It remains to be seen just how fast some of these things decelerate. I suspect the rates probably will only decelerate somewhat. Insurance could come down a bit more, given that global reinsurance rates do seem like they're falling now, so we'll just have to see. The real focus is on the rest, though, isn't it? It's the stuff that's outside of some of those special factors. And, you know, that inflation is decelerating, but should still remain around about long-term average. Hence, we have this view that interest rates really only go back to sort of where neutral levels might be based off the forecast right now. So with the OCR, we've got the 50 basis point cut on Wednesday, touch wood. I think we all feel relatively confident about that because the Reserve Bank was as explicit as I can remember they have been for a while about the idea that they thought they'd do a 50 basis point cut in this meeting. And I don't think there's probably been enough in the data since November that would disturb them from that. All the interest is really on what happens after this. We expect 2 more 25 basis point cuts in the April and May meetings, and then the OCR will stay at 3.25% for about a year. And then we would anticipate a return of the OCR back to where I think the neutral kind of level is here, is about 3.75%. And that'll be basically in the period where the economy will be operating a bit above trend, and inflation will be basically fairly well anchored. Long-term interest rate forecasts, basically the market has got priced in pretty much the whole forecast, all of the forecast, perhaps even a bit more. So we don't really think that things like 2 and 5 year swap rates have got very much further to fall as well, and indeed will probably gradually drift up as we get later on through the year, and the market increasingly focuses on what happens next after the Reserve Bank stops easing. So it is still that kind of higher for longer sort of like picture that I was talking to you about with respect to the global interest rates in terms of the wholesale interest rate view. And that's another reason why we don't really expect interest rates, mortgage interest rates, to fall much lower than Westpac's market leading 4.99% interest rate. So that's the economic outlook. I'll pass it on to Imre now for his view on the markets.
Thank you, Kelly. With that as the backdrop, where are the markets going in the next 3 months? I don't dare go any further because I know nothing about even going out 3 months, but at least I have a stab. 12 months just scares the bejesus out of me. But anyway, 3 months ahead, we think the Kiwi US is probably going to end up a bit lower than where it is now by the end of the period. But initially, there's an uptick, and I'll explain why. Kiwi Aussie drifting gradually and slowly lower. Interest rates, short and long maturity ones, more or less ranging sideways in recent ranges before gradual upticks later. And the yield curve, possibly at the tail end of that horizon, starting to flatten. A bit more detail on all of these things. Firstly, looking back at the Kiwi-Aussie forecast that we made here 3 months ago. What do we say? How do we go? We said it would fall. Yeah, that worked out all right. Magnitude, we probably undercooked it. 58 we said. That was a technically inspired level, but it actually broke through that and went further down to about 55. So overall, pretty good forecast. The rationale for that was the strengthening US dollar. We were expecting that to continue with some energy over the last quarter, and that indeed was the case. Recently, we've stalled, and for the period ahead, we've got a small uptick for the near term. I'd call that the next few weeks. And then the latter part of the 3 months ahead, resuming that downtrend to test that 55 area. Looking at a longer term kind of technical analysis type of picture, it's interesting. I don't usually put in these technical analysis charts, but this one's interesting because going back 5 years, you can see around that 55 mark, that's been a very strong base for the Kiwi US. If you want to get really precise about it, 54.70 is your big number. We had a go at it recently, didn't break through. But if we're right about our medium-term outlook, all the stuff that Kelly talked about, the Trump stuff, the US dollar stuff, you would expect it to at least have a crack at 54.70. Now, if that breaks, there's really daylight between there and 50 cents. So I'm not saying we're going to 50 cents, but it's a if. It's a conditional statement. So we'll get excited about it if and when 54.70 breaks, but I would expect that to be retested sometime over the next few months. Okay, getting away from technicals into more fundamental type things, it's been all about the US dollar and the strength in the US dollar. You can see that red line had a really good run since October or September of last year. Taken a bit of a breather, but there have been some reasons for that. Initially, the US election and the lead up to it, the expectation that Trump would win, and the aftermath when he won, a very strong US dollar view formed. The idea that he was going to really galvanise the economy and whack on lots of tariffs, and they were both going to be very, very positive for the US dollar. That grew to be a very strong consensus, widely held view, which is where it is today. Since then, since his inauguration, the market has become desensitised with the stream of threats on trade tariffs, and then the news about negotiations and softening and then strengthening, and it's back and forth. The market's kind of just pushing it to one side and say, okay, we're priced in plenty for this tariff risk. We don't know what's going to happen until about April, and we'll come back and look at it then and price in more if need be. So I think that's where the US dollar is right now. It's taken a bit of a breather. It might actually sag a bit more in the near term, which is one reason why you would think Kiwi US might just actually pop a little bit higher. Interest rates also as a slightly separate channel. US economy doing pretty well. Fed's on hold. They're going to be on hold until the second half of this year. Market's got July as the next cut priced in. Our house view is they don't cut it all anymore this year. So it's not till next year that they resume. Whatever, we're on hold with the Fed, whereas the Reserve Bank of New Zealand is going to carry on cutting. So that could, depending on how they compare with what is priced in the market, that could actually push these yield spreads a bit lower. Kiwi US yield spreads are at decade lows. You can see they're the lowest since 2016 for the 2-year here, but very, very low levels. But not taking away that they could actually fall a bit further still. Chart I don't often put up, but it's an interesting one to just look at kind of bigger picture perspectives on where could the currency be over the next year. Having just said I don't predict anything out more than about 3 months. The option market, I'll use them because they're very smart people, these currency option traders. And they trade options, and inherent in option prices is a probability distribution for whatever the option's in. So in the case of Kiwi US, there's a probability distribution which you can suck out of the prices, and there it is. tells you that in a year's time, the bulk of the likelihoods for the Kiwi US range between about the mid-40s and kind of the low to mid-60s. Now that's pretty wide, but it tells you something. And interesting for me is if you compare it with, say, the long-run history of the floating exchange rate, it is actually significantly to the left of that. So what it says is the currency option trading market thinks Kiwi US in a year's time is going to be more likely lower than the average since inception of the floating rate. No, there is a bearish skew. If you really squint hard as well, you can see there's a slightly fatter tail on the left here. They're assigning a bit more probability to the downside risk rather than the upside risk for Kiwi US. So yeah, the options market's on board with this bearish bias for the Kiwi US. Okay, so those are the negative stories. But what about this positive story? We've got this uptick over the next few weeks. Positioning, I think this is a big one. Markets are all over the trade. They've positioned themselves to extreme levels. They have shorted the Kiwi. This red line comes from the Kiwi US futures market. It's quite an active market, and one useful byproduct is the CFTC collects from all the traders what their positions are every week. And traders have to tell them, is it speculative or non-speculative, and a few other things. Anyway, this is the speculative positioning. I've done a bit of synthesis on it and arrived at, to make it sort of comparable to the olden days. But short positioning in Kiwi US is about as short as it's ever been. It's extremely short. And what happens when everyone's the same way? You're vulnerable to at least a partial reversal. So I think positioning is a warning that this bounce in Kiwi could extend further. Another thing is, and this is one thing that a lot of corporates like to look at in terms of where should we hedge. Is the Kiwi abnormally low or high? This one says it's actually quite stretched to the downside. And relative to the average, it's just over 2 standard deviations below it. It doesn't often get this low relative to the average. Where's something considering, for those who are considering, say, buying Kiwi as a hedge, not a bad place in the mid-50s. Right, on to Aussie Kiwi, or Kiwi Aussie in local terms. We picked that it would fall a bit last time, down to about 89. It did early on in the forecast, then it kind of just dribbled a little bit lower, but there is a bit of a negative bias in this cross, and we think that's going to persist. The main story there is kind of a big picture backdrop. You know, things like the current account and fiscal deficits are still easily stacked in the Aussie dollar's favour. Yes, our current account deficit is going to get less worse or improve slightly, but still be negative. Our fiscal balance relative to Australia's, though, not so flash. So overall, longer term fundamentals argue that the Aussie dollar should prosper relative to the Kiwi. More short term though, with all this tariff noise, metal commodities have done very, very well. And Aussie responds to metal prices more than the Kiwi does. Things like gold, copper, which made record highs over the last week. These are things that are helping prop up the Aussie and will probably do so at least over the next few weeks or next few months. But the other big thing, relative interest rates. This is a bit harder. Relative interest rates have fallen, Kiwi relative to Aussie, and again we're at decade lows. This is a really big week for Aussie and New Zealand interest rates, and then the spread between them. We've got an RBA meeting today, we've got an RBNZ meeting tomorrow. They're both more or less fully priced for respectively a 25-point cut and a 50-point cut, so it's going to be all about the guidance. And I think the market's going to respond to that in terms of, is the guidance more dovish or hawkish than what they think and what they had priced in. That's what's going to move the currency. I could make an argument either way. I think it's binary risk in both cases. So this one could really disturb this yield spread level in either direction. I don't think the yield spread on its own, given it's stabilised at a fairly low level already, is going to be a good predictor of where it should be. But after the next 2 days, I think we'll have a much better insight into where it might go, depending on what surprises we get out of the two central banks. So that takes us on to interest rates. And last time around, we thought more or less raging sideways. It did actually poke a little bit lower, but not convincingly so. There wasn't a follow through. We made a cycle low of about 3.33, and that is possibly a cycle low in the 2-year swap rate. I say possibly and tentatively because what is priced in, this black line, is already priced for a roughly 3% OCR, a little bit below Kelly and team's forecast, but not a million miles away from it. So the market has fully priced in all the information we know today, and it's considerably below the Reserve Bank's forecast. So you're going to need negative surprises from here in order to push that market pricing lower, and therefore swap rates even lower than they are now. So swap rates have baked in everything we know, and in turn, swap rates decide mortgage rates. So you can say the same about mortgage rates as well. You can see that the market pricing line is not too different to the Westpac forecast. Westpac's got 3.25 terminal, market's got about a 3, and then they've got it right, basically bottoming out in the second half of this year, and then next year starting to rise as the markets look ahead to the next cycle, which is going to be a tightening one. What's really different is the Reserve Bank forecast from November. That sticks out as being quite dated. You would expect at least the first half of that forecast to drop significantly, and we think so too. How much could it drop by? One of the tools we use to estimate how much it might drop by is this thing here. We look at all of the economic developments since the last MPS to now, and we assume that we're the Reserve Bank, and how do they compare to our forecasts? Are they better or worse? And then we assign a coefficient to turn them into a basis point interest rate impact on the OCR forecast, and we get these sort of things here. So the two biggies are the GDP, which was a lot weaker than the Reserve Bank had forecast. That's worth about minus 40 basis points to the track. On the other side of the ledger, we've got exchange rates, which are weaker. So that's a plus for the OCR track by about 30 basis points. And then we've got a lot of little ones in between. Net the whole lot out, and we get about minus 25 basis points to the track. So the robot here says the track should fall at the 1-year head point by 25 basis points. We'll find out in 2 days' time. Final topic really is, I said that there was a potential for a little upward inflection, if you recall seeing it on the earlier chart, for the 2-year swap at the tail end of this horizon. And the reason for that mostly is to do with potential mortgage fixing. Now, this could be a big deal for the swap market. The pipeline of refinancing over the next few months is quite large. It's much larger than it usually is. And even over the next kind of 9 months, it's pretty large as well. The next few months, to give you an idea, so that's 25 billion per month on average over the next few months, roughly $1 billion per trading day. If all of it fixed and entered the swap market, that's a big amount for the swap market to absorb. What would happen? Swap rates would clearly go up quite a bit. Now, I don't think it's all going to happen. None of it's really happened, or hasn't happened to any obvious degree yet. One catalyst could be the Reserve Bank this week. So if the Reserve Bank gives people certainty, yes, we've cut by 50, and if they say there's only a little bit more to come, then households might go, oh, it's time. And I think that survey you completed earlier on is very insightful. So quite a few people thought the next few months would be a right time to do it, and a lot of people thought that the second half of the year at least would be a good time to do it. So sometime this year you're going to get a lot of refixing going on with these sort of magnitudes. That's going to impact the swap market, and it is going to push swap rates higher on its own. And so when will it happen? I looked at in the past when households have done obvious fixing behaviour. That's the red line. So the red line is all mortgages for fixed periods greater than 1 year, 1 year or greater. So anything less, consider that quasi-floating. We're pretty low. So you can see not many people are on fixed terms, and so therefore it's vulnerable to a reversal higher. When does that reversal occur relative to market movements? And that's, I think, the key one, not so much the OCR. The market line is the blue one. So that's a kind of a one year ahead swap rate, which is a good benchmark for these sort of things. And actually, the answer is there's no consistent pattern. Sometimes the fixing starts a few months after the swap market turns. Sometimes it coincides, and sometimes it even starts beforehand. We don't have a huge sample history here of turning points, but you can't take away from this that the mortgage market is necessarily going to start fixing a few months after the swap market has turned. And the swap market arguably may have turned already, as I said earlier on. There's tentative signs that we've actually bottomed out in fixed rates. And if that's right, as a big picture, simple takeaway, I'll take away from that, if the swap market has turned, we're probably not too far away from the point that swap fixing behaviour is going to start kicking off. And I think you can certainly expect that sometime this year and probably over the next 6 months, and that's going to push swap rates higher and in turn mortgage rates higher. Okay, so I'll finish there, and thank you very much.